Okay, chapter 9 practice exam. I don't know why I got that underlined, but anyway. And then we're going to do the chapter 7 handout. Bank reconciliations. Okay, so start with this practice. I think we're going to do today. Gonna be a little different. Just for time. I think we're going to do the part. I usually give you guys the part 1, and you guys do it on your own, and then we do part 2 together. I think we're going to do both these together today, just to move things along, so we're not here until midnight or whatever. Okay. So let me pull up. Okay, so you should have got the chapter 9 practice exam part 1 in your email. It's also in Blackboard. Okay, and I think I'm going to go ahead and do the. I'll set the poll up so you guys can get credit for it. Okay. So we'll go through each of these, and I think we'll just kind of talk about them as we go along. And yeah. Okay. I gotta do something here. Can't see my screen. Okay, now I can. So how many are there? 7? Yeah. Okay. All right. So the part 1 of the practice exam. Okay, now depreciations for those things that did decline over time. And so the question here is, which one of these do not decline? In other words, which one of these are we not going to depreciate? I think I mentioned this.
Land. It's land.
Land. Yep. Yeah, land doesn't go away. You know, you may have to tear down the building or, you know, put a new parking lot or whatever, but the land underneath it sticks around forever. Near enough that you don't depreciate. All these other things are things that don't last forever. All right, these things, what am I doing here? Okay. Number 2 is one of the more difficult ones. I think I talked about this. I think it might be in the handout, maybe in the first part of the handout. Depreciation is a process of allocating plant costs over the useful life in a.
I'm thinking B.
Yes, good. Systematic and rational. And those of you that are going into accounting, remember that. I'll remember that because it's that way for inventory, for cost of goods sold. It's that way for you know, depreciation. That systematic and rational, it comes up a lot, and that is it. A system means that you have to be able to do it. It's repeatable, and rational just means that it makes sense. And you know, I know that we have all these different ways of doing stuff, and you know, but that really is the rule. It basically has to be systematic and rational. Okay. The cost of a long-term asset is expensed
In A, in the period in which it is disposed of.
Nope.
When it is paid for, no.
Nope.
As the asset benefits the company, no. I did D.
Nope.
C.
Yep. Z, you dismissed C, and that was it. Yeah, and if you think about it, it says that we expense it, depreciation expense. We do a little bit every year. It's over the life of it. So if it lasts for 5 years, we expense it over 5 years.
Most of the long-term asset is expense as the asset benefits the company.
Right.
I see.
Yeah. So it's kind of a funny way of saying it, but as for if we use it, if we have the asset for 5 years and we use it for 5 years, that's when we expense it over the 5 years. Yeah. The book value of an asset is equal to, this is just kind of a.
It's equal to B.
Yes, it is.
Yes.
The cost minus the accumulated depreciation.
Yeah.
Depreciation is a process.
Oh, is D.
Yep. Yeah, it's an allocation. It doesn't necessarily match the market value. It might just be out of dumb luck, but it's not really there to say, okay, this, if you buy a car or a truck or whatever, you're not trying to find what the market value is of that vehicle. You're just trying to find, you're just trying to allocate the cost over it. In computing depreciation, residual value is?
In computing depreciation, residual value is subtracted from accumulated depreciation to determine the plant's asset. An estimate of plant's asset value at the end of its useful life. Ignore all the fair value. I think it's A.
Nope.
No, residual value is subtracted from accumulated depreciation.
The thing about we add it to the accumulated. I'm sorry. It doesn't. No, I'm being silly now. I was thinking, this has nothing to do with it. So the residual value is just what?
Well, it has to be B then. It can't be ignored.
No, it cannot be ignored. So it should be B.
It is B.
And ignore it.
There actually is a method that ignores it. The IRS code, they ignore it. It's they use double declining balance method is a different method, and then they ignore it. But they do it for you like that for because it increases your expenses, which is good for taxes. Okay, 7. Equipment. Estimate life is 40 years. Straight line method. Residual value, don't ignore it. Oops. Think you have the answer, yell it out. Or just put it in the chat. Either one.
I got D.
I guess I gotta work it out. All right, we have a cost of 25,000 minus the residual value. $210. All right, and then we, let's see, we divide that by 4 years. Do 500, and yes, it is. Very good. Okay, so let's do a recap. 1 is A, excuse me. 2 is B. 3 is C. 4 is B. 5 is D. 6 is B. And 7 is D. So go ahead and fill those in on the multiple choice on the poll thing. For 8, 9, 10, just right, you can click on anything. But yeah, I think there actually is one for.
My poll just
I don't see it.
disappeared.
Yeah,
It disappeared. I don't know where it's at.
I don't see it.
What'd you do with the polls, you two? All right. All right.
It's not here.
I'm not sure.
Yeah, it's not here.
One second.
Okay.
Yeah, did you guys find it or no?
No.
No?
Did you find yours?
No, I didn't. Just give it to us. I mean,
Hold on. Do you on your screen, do you show 1 or 2?
Nothing is showing on my screen, just your screen.
no, it went away. It's like let's
Everything
see.
went away, yeah. Something went wrong somewhere.
And there's nothing, there's no second window. There's no second Zoom window.
Let me see. Nope, on downside it. I don't see nothing.
I don't see it. Maybe you can create a space and then we load it on Blackboard.
Zoom poll. I tell you what, let's do this. Just put in chat.
All the answers.
No. Just put in chat your names,
Oh, okay.
and then I'll have it. So in the chat, if your poll disappeared, just put in your name.
Oh, disappeared. I'll put that.
and then I'll save the chats, and that'll be we'll use that instead. That's weird. It worked before though, right?
I saw it the
saw
first
before,
time,
yeah.
and then when we
Yeah.
were going through it, it just disappeared.
Huh. All right. All right, so I'm gonna share my screen again. So, not that. No, not that. This.
Okay.
Yeah. So the answers were
A, B,
A, B, C,
C.
B, D, B, D.
Okay, so these are the shoot. Oopsie daisy. Okay. Plant. Oh, no. A, B, C, B, D, and then B, D.
B, D.
Yeah. Is anyone else having a problem with the poll?
Well, I did in Veronica. So I don't know who else.
All right, I'm gonna go ahead and close it then, I think. Is there anyone still working on the poll? Bring those in. Okay,
When is our last meeting?
next week.
This week, okay.
Yeah, and actually, let me put that up.
Wow.
I
That's
know.
quick.
I know. It's
So-
I wish I could have you for the next class of accounting.
Yeah, it's very strange.
Yeah.
I got all I got all these graduate classes, which
Oh, wow.
I'm lower down on the totem pole, so usually like all the higher ups grab all these, like the graduate classes, and for whatever reason, none of them took it. So
Wow.
when I got things like, oh yeah, okay. So this is what we're gonna do. So next week is week 15.
wow.
Next week we're gonna do the chapter 8 handout. And we're gonna do the chapter 7 and 8. I'm combining chapter 7 and 8 as one exam.
Mm-hmm.
So. So those are we do next week, which is week 15. And then I will also send out the chapter 7 and 8 exam. And that will be due on it's the 17th. Yeah. And next, now week 16, we don't have a class week 16. However, I will be here if anyone has any questions or anything that they want to go over. So there's no new material for week 16.
Mhm.
So week 16, I will still be here. So if you tune in, you'll see me, but there's not going to be any new material covered. And at the end of week 16, that's when that's this. That's when the test is due. So that's it. That's the quarter. So I'm going to combine chapter 7 and 8 into one. Okay, well, let's go ahead and jump into. Let me save this. Let me see if we can get rid of that. How about that? Let me get rid of this too. Okay. Let's go to part 2. So part 2 problems, they're going to be a problem that's going to have the same it'll have the same problem, but you use 2 different methods, the 2 methods, straight line, and then also the units of production or units of activity method. Okay, so what do we do with this one? Truck, we'll say this is equipment. So for the straight line method, what do we do?
FIFO.
No.
Oh, straight line.
Oh.
that chapter does traumatize me. All right, so we take the cost.
The cost of it less the residual value divided by the year.
So cost is 100,000, residual value is 5,000, and then it has a life of 5 years. Okay, so and again, you should know something about this depreciation that's probably pretty obvious, and that is that these are all estimates. And the purchase price isn't the purchase price whatever you paid for it, but the residual value, that's an estimate. We don't know really what it's going to be worth in 5 years, but we put an estimate, and we don't know if it's going to last for 5 years. It might last for 4, it might last for 7. So these really are kind of estimates that we're using on these, and they're not going to be perfect, but hopefully they're close. So this goes their depreciable amount. And basically it says this: we have an asset that costs 100,000. It's going to go down to 5,000. So it's going to depreciate by
95,000.
5,000 exactly. By 5 years. That 19,000. I better check.
It's 19.
Yeah, okay. So this is the depreciation expense per year. So every year we're going to depreciate 19,000. So in 2001, we'll depreciate by 19,000, 2002.
19,000.
Yeah, 2003, we know that we were only do the first couple of years, but yeah, so every single year is exactly the same. They call it the straight line method because every single year we're going to take off 19,000. And it's going to go from 100,000 down to 5,000. Okay, the asset, the total cost just sits there like a lump every year, so exactly the same. The accumulated depreciation, that's all the depreciation to date. Now, the first year is going to be what?
This year, 19,000.
Yeah, you've only had for the first year, so 90,000 would be the only. Okay, and now for my.
So the next one would be 38.
Yes. So the next year will be 38,000. Because it'll be both. Actually, I'm going I can get some more arrows here. It'll be both these years together. Whoa, that's not. Oh, hold on a second. Okay, sorry about that. Now, to get the book value, we got to take the cost minus the accumulated depreciation. Oops. What's it not doing yet? What's going on here? And that goes what? So 100,000 minus 19,000 is 81,000.
0.
And 100,000 minus 38,000 is
62.
62. Yeah.
Okay. And you'll see it keeps going down by 19,000 every single year. And it's doing that because this accumulated depreciation is, keeps getting that, and then this will eventually go up to 95,000, and this equipment will only be worth 5 at the very end. So that's a straight line method. And again, it's called that because of this. It takes off the same amount every single year. 19,000, 19,000, 19,000, 19,000. And it's probably the most intuitive way, that most people think about doing this. Is that, okay, it's gonna last for 5 years, we'll split it up over 5 years. Okay. Let's go to, this next one's a little bit more involved, and it's for those things that you don't use the same every year. The idea is exactly the same, you divide it by its life. But instead of using the life in years, you're going to use it in some kind of units. And so here you see that, you know, the useful life is not in years. It's still a useful life, but it's saying, okay, you know, this is a truck, so this is going to be in miles. How many miles we use it. Okay. Starts out exactly the same as the other one. In fact, feel free to cut and paste that. So up to this point, it's exactly the same as we did before. Same thing as a straight line. Now, when we divide it though, we're not going to use years. We're going to use miles. So we're still talking about its life. We're saying, okay, instead of measuring life in years, life in miles. So this will be divided by So this will give us our depreciation per mile. So 95,000 divided by 250,000. Oh, my calculator. Oh, my calculator came up.
0.38.
I got 0.38, yeah.
0.38. Okay.
Sorry.
Okay, so this is 0.38. So like 38 cents a mile. And by the way, this is what the use for taxes, basically this method. Okay, so let's see. I'm gonna do something different. Oh, right here. Okay, so 20,000 miles. Okay, I'm gonna do something different here. There we go. So miles, 20,000 for 2021 and 60,000 for 2022. And you can kind of see that, hey, that these are they're used for different amounts each year, right? They're not used. If they're used pretty much the same amount, you can go ahead and use a straight line. Okay, so 38 cents times 20,000. 76, so 7,600. The depreciation. And 60,000 would be, well, 3 times that, right? 22,800. Oops. Okay, so this would be The depreciation in those funny lines on the bottom. Okay, so the first year we depreciate 7,600, and the next year 22,800. And again, they're different because we use it for different amounts. You know, these over here are different. So, you know, if you chart this out, it'd be hard to chart this out because it would be, you'd have to wait for each year to come around to see how many miles you used it. Okay. So 100,000, the depreciation expense is 7,600 in the first year and 22,800 in the next year. So first year it's 7,600. The next year it would be something else. Let's see here. Add those two together. $30,400.
Yeah. 3,400, yeah.
Okay, so just like before, we're going to take the subtract out the accumulated depreciation, make this a book value. So that's 92,400. And 69,600. Maybe I check those. I think those are right. All right. Question on that thing?
No.
No. Okay. All right. So this will be turned in. Just part 2 turned in. And the next thing we're going to do is the bankruptcy. I think I want to talk about something a little bit different here. Internal controls. I'm going to talk about that for just a minute. And I think we'll take a break after that. And oops, that's not me. That looks exactly like my dog, though, just so you know. Okay. So the next chapter 7 is we're going to do the bank reconciliation, which is one of the things we call internal controls. And internal controls are really those things that companies use to help ensure that their goals are being met. And what I mean by that is that they want things that they want to try to ensure that things happen or don't happen that would benefit the company. For instance, if you go to a drive-through there's usually a person that takes the cash, and then you go to the next window and somebody gives you the food. Now, the question is, why don't you have the same person do both? Why don't you have the same person take the cash and then give you the food? It'd be much more efficient. Instead of having two people, you could just have one.
I think for faster service, so they can move faster.
Could be, but you notice that even when it's slow, a lot of times, you know, they'll have that.
I don't know.
Is it more for quality control?
Yeah, could be. The thing that they probably do it for the most, though, is they want to separate out taking the cash and giving the food.
The food.
Because, you know, if you work at McDonald's as a cashier for one day, you're going to know how much a Happy Meal is. Okay, it's $3.38 because you sold 50 of them. And so what you could do is someone comes up, wants a Happy Meal. Okay, it's $3.38. They give you the money, you give them the Happy Meal, and you don't ring it up. You take the $3.38 and you put it in your pocket, and you know, that's it. So they try to separate those things out. So, you know, those places, someone else will ring it up. It'll go flash up on a screen saying, here's the order. And then they go fill the order in a different area. They say, oh, well, if they, you know, and if they don't ring it up and put it on the screen, you're going to go to the next window and they say, well, we don't have that order. You know, so it's there to ensure that it's rung up and that the money will then be put in the cash register that they can count. Again, you know, things like that happen so commonly that we really don't even think about it as to why they do it, but that is, you know, is to make sure it gets rung up. Sometimes you'll see, they'll say, if, you know, if we don't give you a receipt, let the manager know and you'll, you know, pay for your meal or give you $5 off or whatever it is. One of the reasons why they want you to do that, not necessarily because they want you to have a receipt for any reason, but they want to make sure that it's rung up. So they put it in the cash register, ring it up, and give you a receipt. They're more looking at that as actually rung up than if it wasn't. So, you know, these are things that are internal controls that, again, it happens so often. Another one that's common is if you're in a store like, well, Walmart does this, and so does like Home Depot and other stores, where you leave the store and they'll check your receipt. You know, they'll check what you bought versus what's in the cart. And why do they do that? You know, you leave the store and you hand them the receipt, they look at the receipt and they, you know, whatever.
Make sure you're not stealing.
Possibly, yeah, and there's that's not you know, it could be. Now, you know, people shoplifting a lot of times won't put the stuff in the cart, but they could, you know, they could do that. It actually, you know, while it is, yeah, to see if customers are stealing, they're more interested in that employees aren't stealing. You know, you have family members come through, you know, ring, and they have 5 things, and you ring up 3 of them, and you know, they walk out with 5 things. That's what they're more looking for. Employees steal, you know, you talk about shoplifting versus employee theft. In most retail places, employee theft is 5 to 6 times higher than shoplifting. They lose a lot more money to employees than they do to.
They now, everywhere now, though, they have self-checkout.
Well, yeah, and now the self-checkout is a little bit different. Now, when they're doing the self-checkout, then yeah, they're looking to make sure that you scanned everything through there. And by the way, one of the reasons why they do that is a lot of time, you know, it is, again, if you take the employee out completely, again, they lose more money to employees than they do to customers. So having said that, you know, they're more likely to trust customers than they are the employees.
That's interesting.
It is interesting, but so
Yeah, that is.
so but that's really what they're doing there. You know, well, yeah, they are checking to see that maybe you didn't, you know, you tried to sneak something through in the cart. More than likely, shoplifting, you know, they don't put it in the cart, but they're more looking to make sure the employees, and especially places only like, well, it could be any store, but also like Home Depot, you might be talking about very large dollar amounts, hundreds of dollars, that if someone didn't ring it up, it's very tempting to do stuff like that. So this can really, but again, these are controls that they have, but they are, again, we see them so often, a lot of times it doesn't even register that this is actually an internal control, but that's what those things are. So, okay, I tell you what, let's take a break. Come back at what, 7? Okay.
Yes.
Okay. Come back at 7 and then we'll start in on chapter.
Yeah, period. I hope you're not lying to your father, son.
Right here. Be back at 7. Okay, we'll go ahead and get started. Bank reconciliation. Bank reconciliation is trying to determine what your actual, how much cash you actually have. And that it's sort of like a checkbook, you know. Back when we used to have checkbooks, I don't know if we have those anymore, but it was to make sure that your whatever you are, whatever you have in your cash account, that is the actual amount that you actually have. So what we always try to find is a correct balance, and there'll be a bank balance, and those will come off your bank statement. So you get your bank statement, either electronically or through the mail. Whatever amount they have on there, that's the bank balance. And then you'll have the book balance, and this is what you have in your accounting records. So this is on your, if you pulled up your cash account, this is what would show would be in your cash account. So what we have to do is go through these and correct the side that doesn't know, basically. There's things that we know that the bank doesn't know. There's things the bank knows that we don't know until we get the bank statement. So things that are on the bank statement, many of those things we don't know. So that's what we're going to talk about. So coming down here, we have the bank balance is 6,000. And our book balance is 4,500. Obviously, those are not the same amounts. And so it'd be reasonable to ask, well, how much cash do we really have? And there's some things here that we are going to go through that would that we're going to correct. Whichever side doesn't know, we're going to correct their side. Okay, deposits in transit. It's kind of a funny term because transit sounds funny, but these are deposits that are made near the end of the month. For example, oops. So for instance, if you made a deposit in the bank on 1/30, at the end of the last day of the month, is that going to show up in your bank statement? You go to the bank, you make this deposit on January 31st at 5 o'clock. Is that going to show up on your bank statement for January?
No, February.
Yeah, in February, sometime in February, this is going to post to your account. Okay, so now you made a deposit, right? The bank just doesn't know. So whose side are we going to correct? The bank side or the book side?
The bank.
Yep.
The bank.
Yeah, so deposit in transit, plus or minus?
It's in transit, so you will receive it. So it's plus.
Yep. Oops, I just did something wrong here. Okay. And again, kind of a funny term, but that's what they deposits in transit. That just means that they've, that they were delivered to the bank, but they have not. What did I do here? No, that's right. Okay. So our deposit in transit. And again, we know that we made the deposit. The bank just doesn't have it in yet.
Mm-hmm.
Kind of the same thing for outstanding checks. When you write a check and put it in the mail, does the bank immediately know about it?
No.
No. You know,
No.
it goes through the mail, it goes to whoever is getting it. When they get it, they take it out, they deposit it. It takes time for that to clear. And that. So a lot of times the checks, you know we wrote these checks. The bank just doesn't know.
Mhm.
So whose side are we going to correct? The bank or
The bank.
Yep.
The bank. It's gonna be less.
Yeah. So this money coming out again. We know we wrote the checks. They just don't know it yet.
Mhm.
Minus 1215. Okay, so these are, color coordinate these or not, but and by the way, these two are the most common ones you're gonna find on the bank side. In the book, they'll show things like, you know, errors and all that kind of stuff, but generally speaking, you don't have, those don't happen that often, errors. But every month you're gonna have these two things, or very commonly, especially the outstanding checks. Okay, bank fees. When are you gonna find out about the bank fees? When you get the,
You get the statement.
Where you get the statements?
yeah, now, is there a check written?
Zero.
No, rudely, the bank just takes it out of your account.
Oh yeah, they just do that.
Right. So, let me see here. You know, so you're gonna look at the bank statement, and the bank statement will have the fees. Okay, now, when it comes to your cash, those bank fees, are they gonna increase the cash or decrease it?
Decrease.
Decrease.
Okay. Note collection, I'm gonna take this one myself. Note collection. What is a note? A note is basically the same thing as it's very similar to a check, I should say. A check is a legal document. A check says, when you sign that check, it says whoever has that check has the right to take this money out of your account. So it's a legal document. When you sign it, it authorizes whoever has that to get the money out of your account. A note's the same way. It authorizes somebody to collect that note, to take that money from you if it's signed, and it doesn't matter anything else. I use this note to buy a card. I don't like the card. That doesn't matter if your name is signed on it. It's a legal document. Now you may have other legal wranglings to get your money back or something, but that document itself is a legal document that whoever has that has the right to it. A note's exactly the same way. The difference is a lot of times notes will have, well, first of all, notes are usually for a period of time. A check is for immediately. If you write a check, it immediately. A note is sort of like a post-dated check in that it's for some time in the future. So the 30 days, 90 days, 3 months, whatever it is. And a lot of times there's interest charged on it too. So a note is very similar, except that usually there's a time period. It's going into the future. You're going to collect it. Now, let's say that this is a bicycle shop, and they sell a fairly expensive bike for $1,700. And the customer gives them a note. They go, okay, a note's similar to a check, so yeah, that's fine. Now, this is a bicycle shop. They're not in the business of collecting notes. But a note is very similar to a check. A bank is, it is similar for a bank to collect a note. So a lot of times you can say, okay, the bank, I have this note, can you collect this for us? And they'll say, yeah, we'll collect it. They charge you a fee, they're not they're not that nice, but they, they'll collect it for you. Now, when are you going to find out that they collected that note?
When you get that statement.
Yep. So you're going to find out when you get the bank statement that they collected it. And interest income, you might earn interest on your account, on the balance in your account. You may also earn interest on this note. And again, you're probably going to find out about that when you get the bank statements. So these three are all things that you probably find on your bank statement. That so you won't know about them to the bank statement. Oh, wait a minute! I didn't do something here. Note the collection of the note. So we found out about it on the bank statement. So it's going to be our books. Are we going to add it or subtract it?
Add.
Add. I should say put the same way, no collection. How about the interest income? Will that be a plus or minus?
A plus. Oh, for the bank, it's a minus.
Well, for you, for the.
Oh, for me, it's a plus.
Yep. Okay, so that's everything, right? Okay, so now we're going to figure out how much cash do we really have? And we add all these up. Okay.
So we have 6,000.
$62.35.
Yeah.
Yep.
And hopefully this other side comes up to be the same. $35. Yep. So these two should come out to be the same, and this is the true amount of cash that you have. So you don't have 6,000, you don't have 4,500, you actually have 6,235. So going into February, that's going to be how much cash you have. Okay, now there's a problem. And the problem is this. I don't know if you guys just heard that. That this dog just crashed into something upstairs. All right. This account still shows that it has $4,500 of it, the cash account. Now, we know that that's not right. We know that the correct cash is this. Oops.
6235.
Yep. Did something funny. You know, this is the something here. So this is what we should have for our cash, 6235. The problem is we have 45 100 sitting in there. So what we have to do is we have to make journal entries for these things that are on our side of bank reconciliation. You know, the bank doesn't let us change things on their side, jerks. But but we can change things. So these are all things that we have to add on to our books. We collected this note, we had some interest income, and we have bank fees. So we have to make journal entries for those. Okay, so let's take the note collection, 1,700. Coming down here, cash goes up with debits and goes down with credits. So for that one, for the note collection, will the cash be debited or credited?
Notes collection.
Is our cash going to increase or decrease?
It's
On a
what
debit.
It's going to go increase. So it's going to be, yeah, it's going to be debit. So, by the way, I also have this thing at the very end here. I don't know if I can look at that too. Okay, so wrong problem. Okay, so cash. Asset going up. I don't know. You don't need to put that in. For 1,700. Now let's think about this for a minute here, this note collection. So this would be a notes receivable, kind of like accounts receivable. So we had a notes receivable on the books for 1,700. Now that they paid us, they don't owe us anymore, right? So this is not that. So this is actually an asset going down. $1,700. So when we make this journal entry, you know, down here, we're going to put in 1,700. On the plus side, on the debit side.
So the notes collection is the credit?
The notes, yeah, no, well, notes receivable. You know, they handed us a note. They didn't hand us the cash. Kind of like accounts, someone do an accounts receivable.
Yeah.
It would just be a notes receivable. They may even put it into an accounts receivable. But anyway, some kind of receivable. And now that we collected it, though, we have to take that off the book. So our cash goes up, and you know, you'd rather have the cash than a note, right? So that's good. So the cash goes up, and we take the notes receivable off the books. And again, for this one, we're more thinking about the cash, trying to get this cash to this correct number here. Okay, interest income.
Interest.
Is this cash going up or down?
Cash going up.
Going up.
Up.
And the other side would be probably just interest income. It could be interest revenue. It's some kind of a revenue account. You know, money coming in, basically. Hey, I didn't capitalize that one. All right, let's do it again. You have to capitalize it. I'm just doing it to bug people. Okay, so revenues are always credits. So our cash is going up for those two. So if we were coming down here after that one, we'd say, okay, we had a 70 on the plus side. And again, this is just for the cash. Bank fees. Is our cash going up or down?
Down.
Down.
Down. So it'll go down with a credit. Again, you have to put this asset going down thing in there. So is it 30? Yeah. And probably something like bank fees expense, maybe. Or miscellaneous expense, some kind of an expense. Expenses are always debits. Okay, so over here, this would be a credit of 35.
Mhm.
So we add up both sides.
Minus 35. 62. Oh, we got our number. Wow.
6270. 6270.
6230.
6270. Yeah.
Minus 35.
Minus 35. So
6235.
no. Oh yeah, you're right.
I know. You can't always be right for running guy.
Yeah, so this is and this is what we want it to be, right? Because we want
Yep.
it to be the
Cool.
okay. Close enough. All right. Yeah, so we want to be 6235, and so after we make these journal entries, that's what it'll come out to. And then we can start in February of, okay, we have 6235, and we'll, make our decisions accordingly that we have 6235 in our bank account, in our cash. Okay. Let's go to number 2. Number 2, we have something new. Well, I'm going to put the 2. Oops, these are kind of in a wacky order. So the bank balance is 1,900. And the book balance is 1,355. And again, those are the same numbers, and they usually aren't the same numbers. Okay, everything on here kind of looks the same except for this one.
And let's check.
So this is a customer's check. So we got a check from a customer and we thought it was good, maybe even checked to see if it was good. But by the time we submitted it, it came NSF. And NSF stands for not or non-sufficient funds. So not sufficient funds. So this is a customer gave us this check. We thought it was good. It's included in this 1355. We have $130 of this 1355 has this $130 check in it because we deposited. We thought it was good. It turns out for whatever reason that it's not. So the question is, what do we do with it?
We subtract
From which side, bank or book?
from the bank.
Actually, from the book. The bank knows that it's bad. The bank, we probably found out about it on the bank statement. So we're gonna have to subtract it from our books because again, we have $130 of this 1,355 is not really there. We thought it was, we made a deposit with the customer's check, but it's not. So we're gonna take it out. So I will do this one together and then I'll let you guys do the other ones. And again, this is from the customer, not us. We didn't write the check.
Okay.
Okay, so I'll be quiet and see if you guys can figure this out. Sorry. I think you should have got corrected balance of 1420.
Yes.
Yes.
And so this is what we want our cash to be on our books, because that's how much cash we really have. And so we got to make these journal entries here. Okay. So cash, again, down here goes up with a debit. So we'll have. Okay. $15 and interest income. $200 collected from whoever owed us the money on the note. The NSF check is an interesting one. Now our cash is going to go down, right? We thought it was good. It's now we have to adjust our cash because this
It will go down, yes.
now you say what goes on the other side? Now, are we just going to forget about the 130?
No.
Probably not.
No,
You're trying
we
to-
can't forget about it.
No, you can't affect that. So whoever gave you this check, they owe you $130.
Yeah.
What account do we use when somebody owes us? Someone owes us money.
Accounts payable.
Close. When they owe us.
Debts accounts.
And,
So when someone owes us, it's not accounts payable. Accounts payable is when we owe them. It's
Oh,
gonna be-
receivable.
Good, accounts receivable. So accounts receivable, that is an asset going up. So we're not gonna forget about it. Probably call them up and say, can you come get it? You never, quite honestly, a lot of times you don't even know why it was bounced. It could be the bank froze the account for some reason or something. That's the most irritating thing when you go someplace and they'll say, you know, they freeze an account. They say, well, did you buy gas? Yeah, I bought gas. Oh, we froze your account because of that. Why? Well, people, you know, if someone steals your car, they buy gas. Oh, okay. Well. All right. Oh, bank fees. So bank fees are cash going in. Okay, now hopefully when we put all these in here that we will get a, oops, you know, a balance of that. Okay, so let's see. We have a debit for 15, we have a debit for 200. Credit for 130. Okay, so we have 15, 70, and 150. It's 150, 20. Which is what we want.
Mhm. Wow, yep.
I'm on it. Yeah, so with the correct balance 1420, so we get this now our cash equals 1420, and then we're going to start off on in February, and we're going to make our decisions based on cash of 1420 rather than what it was 1355. Yeah, it's bank record. Now, I'll say a couple things about a bank record, just in general. Well, it is to find out what your correct balance is. You know, how much cash do you really have. There also is a you can also catch things like fraud with it too. Suppose you have somebody who takes one of your checks, you know, out of your checkbook, writes it for some amount, you know, whatever it is, $500, and deposits it or cashes it somewhere. You know, how do you find it? Well, first of all, if they take the check off the top, they're an idiot. They'll probably take the check off the bottom or somewhere in the middle of the checkbook. But suppose you know they do that, forge your signature, cash a check. You'd find it on the bank reconciliation. Say, okay, wait, you know, you go through it, check all your numbers, and these two sides don't match. You start looking into why don't they match, and you'd find that, you know, that check would be there, that extra check that you didn't write would be there. They start investigating where it was cashed and who did it, what time, and all that kind of stuff. So, you know, you can catch fraud with it. So, well, it is to get our correct cash, and this is, you know, 99.9% of the time there isn't fraud. It's just trying to figure out how much cash you have. But it is possible that you would catch fraud with it. Any question on that thing? All right, I'll tell you a funny one. When I told you I wasn't a very good accounting student, but when we got to this bank reconciliation, this is like the only thing that made sense to me because I did have a checkbook. And so I would do a bank reconciliation every month. I do a bank reconciliation. And one month I came up and it was exactly $500 off I went through and checked my numbers, and yeah, I mean, this was like the 80s, $500 was a lot more than that. And it was $500 off. It was $500 too much in my account. Couldn't figure it out. And then when I was looking at the bank statements, I realized that from 1 month to the next, they added $500. So for instance, if my account had $1,200 in it, the next month it started out with $1,700 in it.
Oh.
And so I go into the bank and I say, well, look, this
Oh, when they added it, you did not see it, but when they took it out, you saw it.
well, actually, no, they added it in. My account should have been like $1,200. At the end of the month, when it starts the next period, it should start out at $1,200. They had added it to the beginning balance of the next month, $500. And so I go into the bank and I tell them, look, I should have $1,200 from the beginning of the month, but I got $1,700 here, because I thought for sure they're gonna, it's gonna come back to me, And they said, no, this is correct. It's, well, you probably made a deposit sometime, and no, and if I made a deposit, it would be in there. There is no deposit. There's nothing, it just goes from $1,200, and then immediately the next month it's $500 higher. No, it's fine. It's fine. Okay, everything's fine. Oh, okay.
Oh, wow.
So I have extra $5. So anyway, this is where I went away to school at Illinois State. So I went to a junior college for a couple years, and so I'm leaving. I'm saying, look, I'm going to close up this account, and I'm still thinking about this. So I won't go in the bank and do the same spiel. Look, okay, this happened 2 years ago, but this is, because I thought for sure, I said, I'm closing the account. So I want to, show you guys, and they, oh, no, it's fine. It's fine. Okay. So I just kept it. I always thought that somebody would come back to me, hey, you owe us $500. It never happened.
No.
But it was a very strange situation. But I remember going over the account again and again. This has to be right. This can't be, how can this not be right? And sure enough, it was a weird, and again, there was no $500. I mean, back then, there's no way I made a $500. I definitely would have remembered a $500 deposit, and no deposit was shown for $500, and it was exactly $500 even. So I met somebody who worked in a bank, and they said they may have had to balance the books for some reason. They may have just been like playing the lottery or something. They just gave it to one account or two or whatever it was. But yeah. So anyway, a weird thing though. All right. So that's it for this one. Okay, so here's what I'm going to do. I'm going to put on the on Blackboard. No, not that. Practice exam part 2 and the chapter 7 handout. We just finished it. Those we do on the 10th, I think. Yeah, they'll be due on the 10th. But I'll go ahead and put those in Blackboard now. So if you want to turn them in now, you can. And then next week, we will have the chapter 8 exam. Scratch that. Chapter 8 handout, and then we'll have the practice test, and then they'll send the test, and that'll be it for the class. We're getting there. One more chapter.
Thank you.
All right.
Thank you.
All right. Well, have a good evening, and I will talk to
See you next week.
in a week's time.
All right. Thank you.
Have a good evening, everyone.
You too, dear.